Okay, investors, that didn't take very long. We discussed the likelihood of elevated volatility in the first quarter of 2026 last week. And boom, over the weekend, President Trump's re-ramping tariff restrictions in front of his Davos speech and demanding Greenland concessions from Europe caused an explosion in volatility along with a sell-off in long treasury yields on the fear of higher inflation or a greater risk premium for holding U.S. treasuries. Investors, his threats to impose 10% tariffs on European nations that don't follow his lead met with outrage across Europe and the rest of the globe. Leaders in Europe planned an emergency plan to discuss 109 billion tariffs on U.S. goods. In less than half a trading day, the S&P 500 wiped out its year-to-date gains for the year. Returning from the long weekend, the S&P 500 fell minus 2.1% Tuesday, its biggest drop since last October. Technology stocks were the biggest losers on the day. The Dow Jones lost minus 1.8%, and the NASDAQ shed minus 2.4%. As we said in our weekend update to start the year, he's back, referring to the president's history of Thursday afternoon, of weekend tweets, and position changes that surfaced in 2018 during his first term in his second year. Besides the weekend demands of the president, the markets flipped from complacent to volatile, with investors bracing for the president's speech at the World Economic Forum in Davos. The court's expected decision on the legality of key elements of the Trump trade agenda and announcement of the next Fed Reserve chairman. Do any of these items materially change the outlook for earnings in the S&P 500 over the next 3 or 4 quarters? Given the big, beautiful bill accelerated depreciation provision, given the tax law changes that should help consumer cash flow in the second quarter? Doubtful. But marginally, they do raise concerns about higher inflation and slower growth, which usually translates to lower valuations. The CBOE Volatility Index, that's the VIX index, or the fear gauge as some like to call it, surged past 20 threshold on January 20th, marking a shift in investor sentiment, with investors' New Year's optimism of Goldilocks colliding with a wall of geopolitical and fundamental headwinds. The VIX index closed at 20.6 Tuesday, a nearly 28% jump in a single day. Much as we previewed in our 2026 outlook and highlighted just the prior week, the index signaled a short-term end to the low volatility environment that characterized the second through fourth quarters of last year, post-April's tariff tantrum. The recent spike was caused by an ultimatum from the White House regarding European trade, some negative EPS revisions, and a spike in inflation expectations. The immediate implications of this volatility spike were profound as the cost of portfolio protection over the next 30 days skyrocketed, and the appetite for tech and growth stocks reversed lower. With the VIX trading above its historical average, many market participants are now bracing for a period of heightened turbulence and volatility. But I'd like to compare the VIX index versus tradable VIX futures. Here's what it looked like a week ago. The data is on the left, the graph on the right. I like to call this shape steep but cheap. That is, relatively cheap to buy protection for a portfolio for 30 to 45 days. Investors, here's the current shape as of Tuesday, the 20th's close. This structure is dramatically different than the one just 1 week ago, as it's now approaching a flat volatility curve where the cost to protect a portfolio for a few weeks or even a few days is the same as it would be for protecting that portfolio for 5 to 6 months. We've discussed this dynamic many times the last 7 years on Stock Talk. In simple terms, we're nearing panic level short-term to protect one's portfolio over the next 1 to 2 months. Is panic super high, screaming off the charts, step in and buy all those stocks and assets you think you missed out on the last 10 to 12 months? No, investors, not yet. As when that happens, and when investors are forced to buy protection, not just volunteering to buy, the cost of near-term protection can reach a premium to forward costs. A premium that has exceeded 25 to 40% under times of severe panic and distress. The financial term for this type of structure is backwardization. That's when the near-term protection costs far exceed future costs. Does this structure make logical sense in the protection markets over months or quarters? No, of course not. Why would you spend more to protect your portfolio for only 1 to 4 weeks when you can get a longer tail protection that lasts 3 to 6 months for the exact same costs? The good news is this structure, even though it's approaching flat, still says the same thing to me. It says markets participants are likely to buy the dip if and when forward volatility futures levels cross the 22 level and the front months of the vol curve rise and catch up to that level. The first level looks to be around 6,600, 6,660, maybe even only 6,700. The insurance markets or the stock markets, the options markets are hinting that buyers would flood in. Since we never had a parabolic move up, the extended move up in late December, early January, odds of dropping upwards of minus 10% seem to have declined, not risen. Of course, all this is to be seen over the coming months. Investors, unfortunately, 2026 has started off fast and furious in a negative way for volatility. This was a risk our investment team had entering 2026, and why the first video of 2026 was titled Patience after the Guns N' Roses rock ballad. The first half of 2026 is one of those years the options markets were hinting that a real buy the dip moment would come later in the first quarter. That pullback has begun, but neither price nor time looks like it's completed. The good news is that our investment team has experience in these types of markets. Remember, investors, that elevated volatility also means elevated opportunity for longer-term investors. Historically, investors' biggest incremental returns come from investing when volatility is high, not low, and when markets are down and others are acting emotionally, or worse yet, being forced to sell when they should really be pushing their chips into the center of the table and adding to investments. What does this all mean to you? Our advice to you is to keep following our content here at Oak Harvest on our website and our YouTube channels, and we will be addressing our 2026 market outlook on January 29th and a YouTube live stream with Troy, Charles, and myself. Send some questions in advance if you want any special investment topics addressed. Investors, whether you desire growth or income or a combination of both in your portfolio, the entire Oak Harvest team is here for our clients, doing what we can to plan for you and your family's future, regardless of what stage you're at in your career or in your retirement.